Everyone says Bitcoin is too volatile, too risky, too unpredictable. What if that's exactly backwards? What if the thing that scares most people away from Bitcoin is the exact reason it's going to win everything? Michael Saylor just explained it in a way that will completely change how you see this market. Let's get into it. Let me ask you something. When was the last time you set an alarm for 4 in the morning to buy Apple stock? Never, because you can't. The market's closed, the stock doesn't move. Nothing happens until Monday at 9:30 a.m. And even then, you're watching a company that releases meaningful news maybe 4 times a year. That is the old financial world. Controlled, scheduled, predictable, and quietly, slowly, dying. Because while those markets sleep, something else never stops. Bitcoin doesn't close on Friday, it doesn't take bank holidays, it doesn't pause for elections, Fed meetings, or geopolitical crises. It just keeps moving every second of every day in every country on Earth simultaneously. And the mainstream financial world calls that a problem. Saylor calls it the most powerful feature ever built into a financial asset. Here's exactly what he means.
I think, if you listen to people, someone will say, well, this weekend there might be some problem in Iran or in the Middle East. And if there is a problem in the Middle East, and if the U.S. does something with regard to Iran, then Bitcoin's the only thing you can sell, and then Bitcoin price may crash, and we're worried about it. And I'll say, well, if something happens in the Middle East, Bitcoin will be the only thing you can sell. It'll also be the only thing you can buy. And so that just means that a lot of people that want to trade on the weekend are transferring capital to crypto exchanges so that they can either buy or sell, buy, sell, and buy Bitcoin 4 times between Friday at 4 p.m. and Monday morning at 9:30 a.m. And yeah, if you're a trader, what does that make this? It makes it the most interesting asset in the world for you. If you're an investor over 4 years, what the heck difference does it make whether or not it gets bought and sold this weekend? In fact, here's the difference it makes. There's capital, hot money, that's flowing into this ecosystem, into the Bitcoin ecosystem, that otherwise would not be allocated, right? There's a trader, someone's got $20 billion of capital, and their choice is they can either leave it in the bank earning SOFR, or they can put it into the crypto exchange system and they can buy and sell, and maybe they'll make 4% this weekend. Right? When Bitcoin crashes by 5%, there's someone buying while there's someone selling. So people are like, oh, it fell 5%. Well, someone woke up at 4 a.m. on a Sunday morning to buy it at a 5% discount. So someone's going to actually make more money on the weekend than they would make holding conventional money for a year. And that capital is not flowing into New York City real estate. It is not flowing into gold. It is not flowing into conventional derivatives. It's not flowing into NVIDIA stock. It's not flowing into Apple stock. Why? Because you're not buying and you're not panic selling and rage quitting and buying and capitulating and leaping into the market on these volatility waves. So Bitcoin is most volatile because it's most useful.
Did you catch the core of what he just said? The volatility isn't random noise. It's not a design flaw that Satoshi forgot to fix. It is a magnet. Think about what actually happens during a Bitcoin dip on a Saturday night. While your stocks are frozen and your real estate is illiquid and your gold is sitting in a vault somewhere, there are traders in Singapore, Sao Paulo, Lagos, and London who just spotted an opportunity. They're moving capital, real capital, billions of dollars that would otherwise be sitting completely idle in a bank account earning nothing. That money isn't going into NVIDIA. It isn't going into Manhattan real estate. It's coming here, into this ecosystem, because this is the only place on Earth open for business 24 hours a day, 7 days a week, with no gatekeepers and no closing bell. Saylor's point is brutal in its simplicity. The most volatile asset is the most useful asset, because volatile means alive. Volatile means the whole world is paying attention. Volatile means there is always a buyer and always a seller and always a reason to care. boring assets don't build generational wealth. They preserve it, slowly, taxably, and with a ceiling. Bitcoin has no ceiling. But here's what nobody is explaining about this current moment, because if Bitcoin is this powerful, if it really is pulling all the world's financial energy toward it, then why did retail investors almost completely miss this last bull run? That question has a very specific answer, and it's one that should change how you're thinking about what comes next. I want you to think about someone you know, a normal person, maybe a coworker, a sibling, a neighbor, someone who has heard of Bitcoin, maybe even bought a little during the last hype cycle, but when the bear market came, they sold, or they just never came back. That person is not weak. They're not stupid. They're actually the majority. And Michael Saylor just revealed something about that majority that most Bitcoin content creators completely ignore because it's uncomfortable for the hardcore crowd to hear. The number of people who actually want to own volatile Bitcoin long-term, Saylor thinks it might be as low as 1 or 2% of all retail investors. 1 to 2%. So where does the next wave of money come from? And when does it arrive? Here's what he said.
I think that the retail investors that are passionate and committed to digital capital, to Bitcoin, I think they found it already. I think that they've had 10 years to find it. So if you're looking for a non-sovereign store of value, bearer digital asset, I think that sometime between 2010 and 2025, you found it in one of those successive waves. And then you bought as much as you could possibly afford to buy. Okay, and that's fine. I think that if you want to draw the next cohort of retail investors, they don't want a 40 vol, 40 ARR asset. What they want is something more like a 10 vol, 10 ARR asset, or a 0 vol, 8 ARR asset. So I think that the way that we draw the mass of investors is you offer them something like digital credit, like STRC, where we say, well, here's 11%. It's tax deferred. We're stripping the vol off of it. Like the 1 year volatility of STRC is less than the NASDAQ, is less than the S&P index. It's less than gold. Right? I'm going to give you an asset which is less volatile than conventional stores of value, but it's kind of a certain, right, straightforward, defined 10% or 11%, and you get it monthly. And you can test this yourself, Natalie. I would challenge you to test it. Walk down the street and find 100 people and say, would you rather have 30% a year over the next 20 years, but you're going to get 40% drawdowns and 40 volatility. It'll be 3 times as volatile as the S&P index. And, some years you won't make any money and some years you'll make a lot of money, but it'll be 30%. Or would you rather have a bank account that pays 10%, where you can take your money out whenever you want, but you'll just collect 10% while you're waiting? Now ask them, take the survey. I would think, like if you were to say 95% of the market wants a 10% bank account they don't have to pay tax on, and only 5% wants the 30% a year, I think that that's optimistic. Like that's probably too pro-Bitcoin. I don't think 5% of retail investors want to hold Bitcoin and collect 30% a year tax deferred with a volatility that's double or triple the S&P. Like you might find differently. I would suspect it's possible that number is 1-2%, right? So the great mass of the retail investors, they want something which is 2x or 3x or 4x better than a bond fund. or they want something that looks like the S&P but without the drawdowns of the S&P.
So let's sit with that for a second. 95% of the retail market, Saylor's words, not mine, would rather have a bank account paying 10% than a volatile asset paying 30%. Think about what that means. It means the people who are already in Bitcoin, we are a tiny, self-selected group who specifically chose the hard road, the volatility, the drawdowns, the sleepless nights watching red candles at 3 a.m. We chose that. But the next 100 million people who come into this ecosystem, they're not going to choose that. They don't want that. And if that's the only option we give them, they will never come. Here's why that matters for your Bitcoin right now. The real price catalyst for Bitcoin, the thing that takes it from where it is today to the numbers people throw around in these spaces, isn't going to come from converting more hardcore believers. It's going to come from unlocking that 98%, the people who want stability, who want yield, who want something that looks and feels like a savings account but is secretly backed by the hardest asset ever created. And that wave hasn't arrived yet, which means if you're still holding right now, through this drawdown, through this period where everybody thinks the thesis is broken, you are ahead of the largest single capital inflow this asset has ever seen. The question isn't whether it's coming. The question is whether you'll still be holding when it does. But here's the part of this conversation that most people completely missed, because Saylor didn't just talk about retail investors. He revealed something about how Bitcoin is about to restructure every major company on Earth, and most people watching these podcasts have no idea this is already happening. Quick question. Can you name the most actively traded, most liquid stock on Wall Street right now relative to its market cap? Not Apple, not Tesla, not Nvidia. It's MicroStrategy, Michael Saylor's company. This same company that a few years ago was a boring, mid-sized software business that nobody outside the industry had heard of. A company that released news 4 times a year and was genuinely, completely uninteresting to 99% of investors. Then they bought Bitcoin. And now every single $100 move in the Bitcoin price is worth more than an entire year of what that old company used to earn. Their website updates every 15 seconds. They are the most talked about, most shorted, most longed, most analyzed company in the market. How does that happen? And more importantly, what happens when every CFO in America watches this playbook work and starts asking their board the same question? Here's Saylor explaining the mechanics of exactly what they did.
In a conventional company, you have information released once a quarter. So there are 4 times a year, 4 windows a year where there might be information where you might trade the stock. 4 days. And you're expected to not surprise the market, which means that if you're a well-run conventional company, you give guidance and then you hit the guidance plus or minus, and it's really not very interesting. And so someone could pretty much value one of those companies by making a decision once a year. So once a year I decide to buy or to hold the stock and how much to hold, and then like no news is good news and there's nothing else going on, and that's boring, not liquid, not volatile. And then when we got into Bitcoin, we realized, well, we're holding this asset, and guess what? You know, our website updates every 15 seconds, Natalie. Okay, so think about this cycle. We went from updating the financial markets with material news every 12 weeks, once every 12 weeks, to updating the financial markets every 15 seconds. Okay, so yeah, you're going to have weeks where Bitcoin is going to be down. Every time Bitcoin moves $10,000, the company makes or loses $7 billion. Right? $1,000 is $700 million. Okay, let me put this in perspective. It used to be the company worked for an entire year to make $70 million.
It's so crazy to think.
So every $100 fluctuation in Bitcoin is the equivalent of 1 year's work. So what we've done is we have plugged a energy source, a volatility generator or an economic energy generator directly into the balance sheet. and the Bitcoin cycle drives a news cycle. The news cycle drives Bitcoin trading. Everybody is obsessing. So you're on television and someone's obsessing. Well, could it go lower? Well, there's someone who's a skeptic that's thinking, maybe I should short the stock. I think I'm going to go and take $100 million out of my piggy bank and I'm going to short it $100 million. But you know what? They have to buy that back, right? Unless they're lucky enough to short a stock which goes immediately to zero forever. It's only a question of when are they going to have to buy $100 million back, right? They're going to have to buy it back.
I want you to understand the full picture of what Saylor just described, because taken together, these three things tell a story that most financial media is completely missing. First, Bitcoin's volatility isn't a bug. It's the gravitational force that's pulling every dollar of speculative capital on Earth into one place. While every other asset sleeps, Bitcoin is open, and that never stops. Second, the retail wave that everyone expected this cycle, it hasn't happened yet, not because retail doesn't want in, but because the product that retail actually wants, stable, yielding, low drama, hasn't been broadly available until right now. That wave is coming, and it will be bigger than anything we've seen. Third, the corporate adoption story is already written. Strategy proved the blueprint. A company that adds Bitcoin to its balance sheet becomes exponentially more interesting, more liquid, more valuable. When that logic spreads to 5 companies, then 50, then 500, the supply doesn't change. There are only 21 million Bitcoin. Every corporation that adopts this model is competing for the same fixed pool of coins that you are holding right now. So the next time someone tells you Bitcoin is too volatile, too risky, too uncertain, remember what Saylor actually said. The volatility is the point. The retail wave is coming, and the corporate race for Bitcoin has already started. The only real question is the same one it's always been. Are you going to be early, or are you going to be explaining to someone in 10 years why you knew about it and didn't act? If this video helped you see the bigger picture, subscribe. We break down the conversations that matter every single week. See you in the next one.